Hi, so I decided to make this video in terms like of course because it's the better way to show you why 95% or 95 people or 95 retail trader lose money no matter the experience, no matter the analysis that they use, no matter what they the knowledge that they use. It's not related to that. It's just based on the fact that they don't know about like the theory of the fourth lever price that most of institutional traders use. And I've been trading for institutional traders, and I know how they react and how they prepare those kind of theory that we will see here through this quick courses. Okay, so my name is François. I hope that you're doing very well. It's your first time to discover me. I'm the main trainer and founder of Global Street Trader Academy, which is GSTA. You can see actually through different social media. We teach people. We are a online Canadian online academy where we teach people how to trade bond, stock, ETF, CFD, future contract, those stuff. Okay, so if you're interested eventually to know those skills to be confident in financial market, to have to be successful on financial market, I kindly recommend you to take a look on our website, which is globalstreettrader.com, right, in one word, and we see other already set up for you, and also the framework and all the product and also the services that we offer. Okay, so let's jump now to the what's exactly the four lever price theory. Okay, so like let's consider that you're a trader. You face on the market, any type of market. It could be bond, commodity, it could be stock market, equity, or forex, right? And you really looking to buy at the good prices, but you don't know the prices, right? We don't know actually what would be the good prices. So that's why most of retail traders or most of like very experienced traders determine that you need to have a four lever prices. Don't ask me why four lever prices or where those four lever prices come from or how to determine them, right? Because it's a part of my courses. I teach to like the people to determine those four lever prices and how to use them. So if you're interested, you can take a look on the courses for sure. But it's not like the most. It's very important to know how to manage them. But I will show you here why you lose money anyway. Why you lose money on no matter market that you choose. I will show you why statistically the market is playing against you, right? It's based off the expectation value of the gain on different type of market, right? So let's take the way of market, because we consider that the market could go up, right, or down, or stay neutral. So actually there's three ways of free trend that the market could choose. It could stay like steady, right? It could also going up or going down. So for long position, right, we have 33%, right? For neutral position, we have 33 and 33%. Okay, for short position, we have 33 and 33%, right? So if we consider that we do have four level prices spread across to kind of like the prices, it could be technical prices, it could be fundamental or psychological prices, but anyway, we need to have four level prices. So for different level prices, so P1, so price 1, okay, it's given by the probability is 0.25, right, which is 25%, because here any way of the market are equally spreaded, right? So we have 1/3 or different scenario. So here we have also 1/4. So 25%, so 0.5, okay? So P3 will be 25% again, and P4 25%, right? Which is equally spreaded to 1/4. So any price, or no matter the product that you choose, if you take a one trade, you need to have, if you consider that spherically we have 4 prices, they're equally reparted in terms of the probability that each price will be the great one, is given by 25%, right? So the probability that you will make money on your one shot, if you take one position like randomly, the probability is given by so the probability, right, or the price of intervention, so this one, times by the probability that the market could going up or going down, right? So let's say PR1 times PRX, right? Which is 0.25 or 25% times 0.33, okay, or 33%, okay? So the probability to make money on different price intervention, no matter what the product, is 8.3325% or 0.083325. This is actually the probability. Okay, so when you take a position, no matter what you choose the market, if you're doing your great analysis, you're doing your great technical analysis, stochastic, you use any market that you would like to any indicators that you use, your probability to win one trade on your first intervention on the financial market is 8.3325%. So the probability that you will lose this position on your first shot is 1 minus probability of this one. So let's say probability of phi, right? So the probability of the phi, so 1 minus probability of the phi, it will be 0.916675, okay, or 91.67% of the probability that you will lose money. Okay, this is the probability. Like, let's say we can take an example. You take a gold, so you want to buy gold. So the first time that you will intervene in the markets based on the different level prices, if you have like the 4 prices, because you don't know which one of those 4 prices is the right one. But in these courses, and in the courses of the GST, we teach you how to determine the real one great prices for that. But people who don't know, they take another's product, gold or oil or forex, they take a position like your first shot. You just tented in a position. No matter the position, no matter your analysis, you will lose money statistically. Okay, it's the probability. Right. So now we know the probability of the markets. We know the statistic. So now we consider now that, well, we'll based on the fact that I will take a position, my first position, I will lose money. So how to avoid to lose money? It's given by two answers. First time, you need to know how to determine those four level prices. And second one, you need to wait that the market going to the right level price actually to buy your asset, right? So based on the fact that we have four level prices, so we don't know. And you need to also figure out that I want to be successful after my trading session. I want to be in a green. I want to get my P&L green, right? But with this observation, I know that firstly I will lose money anyway. So how to manage that? So let's figure out like some exercise to let them know how to be figured and how to set up the way to to be profitable on the financial market. So I just read again like those four level prices. So we have P1, P2, P3, and P4. Okay, and we determine that we are 25%, 25%, 25%, and 25%. Okay, and depend on the scenario. On the fourth scenario, we have also 33%. Also neutral, we have also 33%. Okay, and the short position, we have also 33%. Okay, and we want to figure out to be profitable after our trading session. Okay, so we need to use the expected value. Okay, so the expected value, as the people which is see this video, if you made a little bit of statistics, just a quick recall, because the expected value, it's like the expecting value if we are doing lots of times of experience randomly, and we would like to see some of observation which is very close to the means, right? So that's why they use a theorem which is called a central limit theorem, right? For any type of like number, real number, which is follow a Z probability with like a theorem central limit with sigma and mu. So mu is the mean, sigma is the variance or the standard deviation, because the roots of the variance is the standard deviation. So it's just a quick reminder for like a statistic notion, but because we need to use that to determine like where is the real prices, or what is the good prices. Okay, so based on this theory or observation or empirical statistically observation, we use that. Okay, and also we know that the expected value for any type of like prices, any type of investment, any things, we need an expected value, so an estimated number, which is called E of X. So it's like some of observation that we're doing again a lot of time, and if we repeat that thousands of times, we're pretty sure that we'll be close to the real value of our estimated value statistically. Okay, so this is EX is given by a sum for I, from I equal 1 to n, or it could be also infinity, by P I xi. Okay, so we know that. So for different different price or different product, they are associated with like a certain of probability of the different scenario or different intervention of the scenario. So if I take the euro dollar, right? The euro dollar is containing 4 prices, and through these 4 prices level, there's a 2 which is going up, there's a 2 which is going down, or there's a 2 could just stay neutral, right? Based on the way what the market is supposed to go, going up, down, or neutral, right? So that being said, through 4 level price, no matter what is spread across different 2 types of the prices. It could be also technical, or it could be also psychological, how you determine the price to do your analysis. But the expectation for the gain to win or to lose money on the euro dollar position, it's based on these formulas. Okay, so this is a quick recall. So now I will take this figure, so very simple figures, and we do it like we repeat the experience for this exercise like 8 times, and we see what happened. Okay, based on the fact that we need to have 4 prices, so we need to repeat those experiences at least 4 times to see where is the real prices to buy the market. Because if you trading some like let's say a future contract, you probably see that people use what is called market profile, right? So the market profile, it's giving kind of a volume like this, right? And you see something like this, right? A volume for each type of market, right? So on this observation here, we do have a bell distribution of the curve, which is like the infiniment law of a distribution, which is we know that the real prices is through this level here. So that's why I said we use the probability Z, which is follow the theorem limits central limit, which is sigma for 1, sorry. So the standard deviation is 1, and the mu, which is the mean, it's 0. Okay, so that being said, below this Bell distribution for a theoretical central limit theorem, we have 4 prices below or inside this Bell distribution, and between these 4 level prices, like under this Bell distribution, we have the true prices where the market is supposed to going, and then we could going up or going down if we buy or you sell, right? So there's like a particular or estimated real prices here. So it's the same like intuition and the same theory that we use to determine like the 4 level prices, right? So it's just a quick call, okay? So let's say we have like those 3 prices. We have like the we choose a product, and we have the probability that will be going long, neutral, short, and the probability is given by 25% by each price of intervention as we described, okay? So the expected value or certain gain, okay, is given by P1 x1, okay, plus P2 x2 plus P3 x3 plus infinity to p n xn, right? So it's a sum. It's a sum of different scenario or different price intervention. Then we can expected the real gain of our investment, or different investment, or different, if you want also you can reason as like a casino, like when you bet an amount, we have an expectation to win on a certain amount, like according to the quantity of amount that you invest. It could be $10, it could be $100, it could be $1,000 and whatever, right? So it's giving by these formulas, okay? So for this example that we choose, we want to determine the expected gain or expected value on euro dollar if I'm going, let's say, long position, okay? So E for euro dollar USD, okay? X, right? So it's given by, it will be 0.25. So the first intervention level prices that we will intervene, right? So the market is we face to the market. We want to take a position. It could be long, it could be short, it could be also neutral, so play between a range. But we don't know. But we want to know what is my expected gain or expected value if I'm taking whatever position between this scenario according to these four level prices, okay? So it's 0.25 times 0.3333, okay, times your investment or your bet. We take $100 to make simple, okay, plus the fact that you do not use others prices of intervention, so we choose P1. So if you choose P1, your probability to win or your first intervention will be 25%, but the probability that you lose because you didn't choose one of those three level prices, it will be given 1 minus 0.25, because remember that the probability that you lose on a position, it was given by 91.67%, right? And when if you will win potentially a position, it will be given by 8.3325, okay, percent. This is your probability that you win, like in first round when you invest your money on different market, or you want to take a position on euro dollar. It could be long, short, or neutral. You're given by 8.3325%, like the first time that you take the position on your first intervention, okay? So it's be 0.75 times minus this one here, based on the fact that you do not use others, you choose one of position, so we don't know the probability that you do not choose like the right way of the market. So minus 1 minus 0.33, which is 0.67, okay, minus times minus $100, okay? So when you invest, you lose money firstly, right? You spend $100 or you spend $1,000. So you invest $1,000, you invest $100, and here you lose also $100 if the market not going to your direction. So if you're wrong, you will lose money with minus $100. Okay, so it will be give here 8.25 here plus minus 50.0025. Okay, so the EX for your first experience on euro dollar, if you buy or if you short or if you just going for the for the range, so you see the market will be stay neutral. If you invest money on this first position, this is your expected gain, right? It could be it's minus $41.75, right? Because here is $100. So it could be also, if it's $1,000, it could be 410, right? And so on and so forth. So this is the first position or your first intervention when you buy euro dollar or you short euro dollar, or no matter the position that you take. This is your expected gain for your first experience. Okay, so we put here EX for euro dollar, or EX1 so EX1, it's minus $45. Okay, this is your first trade that you want to take a position. This is your expected gain. Okay, so let's doing now. We repeat a lot of time because we know that the expected value, it's a simulation that we're doing a lot of time to see what will be the real value according the price that I intervene, or according the level price that I will choose to make money. So remember, I told you firstly when I starting to develop that to resolve this problem, you need to ask in your question, what's the right price to buy, and what time that I have to buy at this price. So you need to be patient and to wait that the market could going to your level, then you take the trade if the market offer you the price, right? So that's why we do the demonstration to see why it's benefit to wait that the market giving to you the right price. Okay, so let's take now for the second one, simulation. Okay, so second simulation, it's EX2. Okay, so now we saw that we will be wrong if we take the position at the first price, because our expected value is negative. So let's say now we will go like for the second price level position according to our intervention. So it will be the same, pretty much the same thing. So we repeat that. So it will be 0.33 times 0.33 times $100. Why 0.33? Because in this scenario, so in this simulation, it's not 4 prices. Now it's 3 prices, because we know that firstly, on the 4 level prices, we know that the probability that the first prices that we choose or that we buy, or no matter the position that we take, the first prices that we will taking, it will be wrong, and we're giving like this negative expected gain. So if we take off the first level prices, it will just left 3 level prices. So that's why we have a 0.33 here, right? And this level, this way of the market didn't change, because we don't know if the market could go up, going down, or stay neutral. So this one like doesn't change. We just want to follow the market. That's why those parameters stay just like fixed, just stay right now. We don't use any type of like calculus to determine where the market could go up. But in terms of like the price action and the price intervention, we don't know, we're trying to figure out what would be this like the right price to buy the market. So that's why after the first prices, which is where we see that we lose money according to the expected value or expected gain, that's why we take now for the free level prices. So now instead to have P1, P2, P3, P4, we have just P1, P2, and P3, okay? So here it is, P3. So that's why we have 0, 33, 33, 0, 33, 33 times $100, okay? Plus a 0, 60, 67, so 1 minus this, and 1 minus also this one, okay? So times 0, 60, 67 times minus $100, right? Because we invest $100 on this second intervention, okay? On the level prices. So we'll be here. We will have 11, because I already calculated for you. So we have 11.1088 89, I think. Yes, 89. Okay. And here we will have minus 44, 88, 89. Okay. So EX of 2 for your euro dollar will be minus 33, 34. Okay. So in this scenario again, if you're doing like a second times on the second level prices between our fourth, we will lose money again. Okay. So we can conclude that the first price was wrong, the second price was wrong. Let's try now the third level prices, okay? That's why, so let me put that here. So EX2 of the euro dollar is minus 33, 34 dollar, okay? So that's why people don't understand. They buy an asset, they buy a product, and the market suddenly going against them. And after 5 minutes, after 10 minutes, the market now going to their direction. And actually they already broke, right? It's because this statistic that I show you right now explain why, right? It's based on the fact that you need to know how to determine these 4 level prices, and to weigh that the market give you the right one. So we're doing a simulation until we found at which one level of price that I'm profitable based on my expecting gain or my expecting value. So that's why when you see some of traders where they draw a support or resistance, they didn't put just a line for support or resistance. They draw a level prices. They're doing like this, right? So you have the market here like this, They're not putting like those things. They're doing those things. So between this level here, between this zone, they already know the fourth level prices, right? So they just know, and they're just waiting when the market could going to hit this level, or this level, or this level for buying eventually the markets, right? So if they intervene here, they could lose money. They could lose money here. They could lose money here, and here there will be the right one to buy, and then the market could going up. That's the secret, right? So that's why we do statistically to see, like intuitively, why you have to waiting about that the market could go into the right level prices. Okay. So we do EX for $1, EX2. Now let's try the EX3. Okay. So yeah, we have okay. So now EX3 for $. So the third level prices. So now we don't have actually 3 level prices in this experience. We have now 2 level prices, right? So a 50-50. It could be P3 or P4 to be the right one prices. We don't have P1, P2. We know that P1, P2 is not good. So now we're trying to do another experience for P3. Okay? So P3, or the third intervention for our experience, will be 0.5, so 50-50 in terms of the spreaded or the repetition of the probability for the different level prices in terms of the intervention, times 0.33. This one didn't change because we're trying to follow the markets. It could go up, down, or stay neutral. Okay, times our investment, which is $100, plus 1 minus 50, so 50-50, okay, times 0, 60, 66, 67, okay, minus times dollar, our times dollar, which show our expenses, right? So it's given by 16 here, 66.5, and here we have 33.5. Okay, so the result of that, so EX3 for $, will be minus 16.67. So you see that the most that we wait that the market going to giving the right price, the better the expected value, expected gain show, right? Showing us, right? So EX3 for $, here on the USD, it will be minus $67. That being said, if we wait that the market, based on the simulation, if the market going to give us our third level prices, our expectation will be minus 67. Okay, so we're not losing 41.75, but we were losing probably minus 16.67. Okay, this is our expectation. So now let's do like the last one. So the four level prices. Okay, so we take now, we are on the last one. Okay, so the last one, EX4, will be 1, right? Because we have, firstly, we have floor price was 25%. Now we have just one prices. So it could be the right one, because we have basically four prices. So the probability is 1 or 100%. So that's like the right prices, the real prices. So 1 times 0, 33, 33, 33, doesn't change, times $100 plus 0, because 1 minus 1, so 1, that's the probability, okay? That is not the price. So that means that we do not trade, because we have four level prices. So if the market bidded our 4 prices, we do not trade, because we don't have other prices. We have just 4 prices. So 1 minus 1, it's 0. Otherwise, we don't trade, okay? Times 0, 67 times minus $100, our investment. So here in this scenario here, we do have 33, and we have here $0, because 0 times 67 times that is 0. Okay, so on the fourth level prices, so EX4 for the euro dollar, the expectation value or the gain expectation is $33. Okay, so that being said, if you weight the market giving our fourth price based on our support zone or our resistance zone, because in each zone we do have like a different prices, which is 4. The fourth one will be like the best price that we're looking, and these prices giving our expectation for $33. So I just want to make clear this explanation. When you draw, okay, when you draw your support or resistance zone, and you have like the different level prices, okay, the right prices could be this one, it could be this one, it could be this one, it could be this one. We don't know where the right price, but we pretty sure at 95% based on the statistic and the distribution, okay, distribution curve, or the involved normal bell, that the right prices is between this level here, is below or under this distribution here, right? The right prices is between them. Others prices like at the out of the bell, which is like, it could be like for the tails of the at the end of the curve, like the they call that the kurtosis. After the kurtosis here, it's just 25% and 25%, but we do have 95% statistically that the right price will be below this distribution. But how to determine this right price, and how to determine also where do you come from, where these 4 level prices come from, that I said firstly, I will teach you that inside the courses. But you can see through sometimes some like traders or future contract traders or like bond traders, they use a volume with market profile, and with the market profile, this indicator giving to you they call that the POC. So POC is based on the same notion of the right price or the fourth price, or the the right level where people need to weigh that the market could hint the market, and after it could going up or going down. But it is statistically proved, right? It could be 95% the time that the market is this level, which is called POC, right? Point of control, right? Or we could call that also point of control, or we could call that also the price of control, right? Price of control or point of control is the same thing, right? But is that those notions call from like statistic, and we do know that all the right prices, the 4 level prices, are below this observation or under this observation. Okay, so remind to that. So now we have the result. So we know that firstly, if we take another, like no matter the position that we take, like the first time that we take, we have just 8.33, 25% of chance or probability that we will make money, right? So it's just like 88% that we will be right to choose the first price for our first intervention, no matter the markets. Okay, according to our analysis or according to our indicators. But we do know also that the most time that we wait that the market coming to test this different level, we do know also that the most time that we wait, the most time also we optimizing the expected gain or expected value on our different investment, or different, if you prefer, different bet that we allow to our product or our asset. So that's very interesting, right? So now let's try to do another simulation, but in this time let's consider, okay, I will just erase that, and so we put in the probability here, okay, percent, and 33.5%. Okay, so now let's consider that we don't have now 3 different scenarios, but we just have 2 scenarios. So 50-50, okay, 50-50. So the market could stay neutral or going down, or it could stay neutral or going up, or it could going up or going down. We have just 2 scenarios possible. Let's take that. Like, we consider that we know a part of the market. So we simulated 4 experience. Now we will simulate again another 4 experience. So in total, we simulate like in total 8 experience, right? To see which one our expectation would be great for us statistically before to invest in different assets according to the price intervention, okay? So we're doing the same thing. So E5 of euro dollar. Now for the hypothesis, we know the market, that we know like one part of the market. So we just have, instead to have like 3 different scenarios, we have just 2 scenarios possible, okay? So now we will have 0.25, okay, times 0.50, okay? So we have 4 prices spread across for 2 possible scenarios, right? It could be up, down, or up and neutral, okay? So times $100 always, it makes easier our calculus, plus 0.75 times 0.50, because it's 1 minus 0.5, and it always here 1 minus the probability of the scenario will be materializing, and also minus times minus $100, okay? So here will be 12.5 plus minus 37.5, okay? So the result of that, so E5 of euro dollar will be minus $25. So in this scenario again, even we don't have we know like a part of the markets. We know that the market could going up or stay neutral, or going up or stay neutral, or going up or going down. If we invest $100 on the first price that the market giving to us, our expected value or our expected gain will be, we lose money on $25. Okay, so I just, if you see here, right, I will be this side. So E5 will be minus $25 in the scenario where we know a part of the market. Okay, let's continue. Okay, so let's calculate like E6. Okay, so you understand now the principle. So I will going like I will make quick. So EX would be 0.3333, okay, times 0.50. All right. So now we don't have like 25% of 4 prices. We have now 3 prices level, so we equally reparted by 33 times $100 plus 0.6667 times 0.60, so 50/50, times minus $100 for our bet. Okay, so sorry if I just want to make sure that you see what I'm right for you. So here will be 16.66.5 plus minus 33.5. Okay, it will be that. So E6 here will be minus 16.67. Okay, so E5 equal minus $25 and E6 equal minus 16.67. Okay, so let's take the right. Let's make that clean. Okay, so now E7 equal times 50/50. So we have 2 prices and we have now 2 scenarios, okay, for realization, times our investment. So we know a part of the market, okay, plus 0.5 times also 0.5 minus $100. So E7 is 0. Okay, so E7 is 0. So that being said, E7 is a kind of scenario where we flat. So we're not losing money, we're not earn money. If we invest in this third level prices in the scenario where we know a part of the market, in a scenario where the market is supposed to going up or stay neutral, going down or stay neutral, or going up or going down, in this scenario case, if we invest in the third level prices on our third intervention, will be flat, break even, $0. So we won't make money and we won't lose money anyway. Okay, very interesting, eh? So now we're doing the last one again. The last one, the fourth one, the great price, E8 will be 1, so it just left one price, times 0.5, or the way where the market's supposed to go, times $100, plus 0 times 0.5 times minus $100. In this scenario, E8 for euro dollar will be $50. So in this scenario, if we know the part of the markets, we know where the market's supposed to go, okay, and we invest, we buy or we short on the fourth level price. In this scenario, we make 50% of our investment. We will gain, we expected value gain, which is $50. Okay, so all this experience that we do, what do we have to retain from? We return from this experience that, as I said, firstly, that it was a demonstration that when you do trading, you have to think about like these things, like to have 4 scenarios on your intervention based on your price level prices, and also you need to wait that the market giving to you the price is the right one, and the right one, I teach you how to get that to my courses, because the right one is based on something that I not reveal unfortunately in this video. But most of institutional traders, they know statistically in 95% that the right price is always between the third price and the fourth prices, level prices. Okay, so that's why I kindly recommend, if you're trading in your side and you see the different price level, when you want to determine like the resistance or the level support or the POC. Usually the POC is the right one, the POC or the price of control. But when you want to determine that, you need to know basically to draw like a level of the zone, which is putting the fourth level prices. Then you can see which one prices will be react to the market, if the market going on this, or it just not going and just going directly in another direction, right? That's why it's very important. So it's finished. It was just that we'd like to reveal. I hope that you enjoy with like this scenario case based on the statistic that I teach you. If you like it, please leave a like on the video, or also you can share to your family and your friend which are interested to do trading. And if you want to go further and understand how you determine and where the 4 prices come from, and you want to know how to to play with these 4 level prices, we're giving that to the training courses for the GSTA. So if you're interested, just let me know that. You can go into the website and write me an email as gstacademy.com, like contact@gstacademy.com, or also leave a comment below this video and we will get back to you for that. Okay, so I hope that you're doing very well with this video. We see you around for the next content. Thank you so much for watching this video. Bye bye.